Basel III norms, this is savior of banks. You all know about Basel or banking supervision. And one thing that comes to my mind when you run any kind of business, there are inherent risks associated with every kind of thing in life. So that's why it is popularly said the biggest risk lies in not taking in any. And I have said this quote by cheating, because in front of me I have mentioned that quote many times. I show my audience that quote. Okay, so let me take you to that screen. If you can see, this is the quote I use it to quote to my aspirants. Can you see it? The biggest risk lies in not taking any. Got, my dear friends? Got it? So yes, so risk is always associated with every kind of business. Whatever business you do, risk is inherent. So banking is always prone to risk because we do a lot of thing in banking. In banking, financial give and take goes on. So whenever there are financial give and take, risk is associated. You have seen it in your day-to-day life. Your friends usually ask money, but when they ask money, they ask very politely, but once they take money from you, they stop receiving your call. So when you are dealing with such kind of financial thing, so risk is inherent, and Basel III addresses that risk management. So let's start. Basel 1, Basel 2 is history. Nowadays in banking, they don't ask a lot of history questions. So Basel III Accord is set by the BCBS, that means Basel Committee on Banking Supervision, with the aim to strengthen the regulation, supervision, and the risk management within the banking industry. Due to the impact of 2008 global crisis during the Pittsburgh Summit in September 2009, the G20 leaders committed to strengthen the regulatory system of the banks. I am telling the history, so little casual about it. So consequently, Basel Committee in Banking Supervision released the comprehensive reform package entitled the Basel III, a global regulatory framework for more resilient banks and banking system. So Basel 1, Basel 2, and Basel 3 are nothing but the risk management framework for banks. Okay, there are crises are bound to hit banking system. So whenever the crisis met, banks should have adequate fund, adequate planning in place so that they rescue themselves. Got my point? The Basel Committee on Banking Supervision. For what? To rescue banks from crisis. Got my point? So history, how the Basel Committee has started. BCBS was established in 1974 by central governments, central governors of the Group 10 countries as a response to the disruption in the financial market during 80s. The committee was expanded in 2009 to 27 jurisdictions, and India is included then. The BCBS reports to the GHOS. Who is the GHOS? Group of Governors and Head of Supervision, GHOS. Its secretariat is located in Basel. That's why it is called Basel norms. Basel is nothing but a city in Switzerland, and it is at its headquarters the Bank of International Settlement. Right? Hello, aspirants of IBPS RRB Scale 2, Scale 3. The good news is IBPS RRB notification could come out very soon. It is being delayed due to amalgamation process, but never mind. Few banks have already reported their vacancies. Few banks are yet to report. कुछ बैंक अपना वैकेंसी दे चुके हैं, कुछ न्यूली अमलगमेटेड बैंक अपना वैकेंसी देने के कगार पर हैं. एक बार वैकेंसी कंपाइल हो जाए, आपका नोटिफिकेशन आ जाएगा. जितना भी डिले हो रहा है, उस समय को आप प्रिपरेशन के लिए यूटिलाइज करिए. हमारे वार्म अप बैचेस ऑन है. नोटिफिकेशन के बाद डेडिकेटेड लाइव सेशंस भी ऐड हो जाएंगे उसमें. जो भी अभी भी जो कोर्स में एनरोल्ड हैं, उनको 9 बजे और 10 बजे एक लाइव सेशन चल ही रहा है उनके लिए. कोर्स link and everything is in description. So how and when the Basel Accord came into effect? Basel 1, Basel 2, Basel 3. Okay, as you all know that no one is perfect in life. Achieving perfection is merely impossible. So similarly, in the year 1988, the committee came up with an idea that we will give a Basel 1 Accord so that no banks will fail. But in 2000, it was increasingly felt that Basel 1 is not sufficient. Then came Basel 2. In 2010, after the recession in 2008 and 2009, it was increasingly felt that Basel 2 is also not sufficient. Then came the Basel 3. Now there is the Basel III norm. But remember, even Basel III is not complete in itself. And it was realized by 2013. Then some enhanced Basel norms came into effect, like your LCR, NSFR, that means the additional liquidity measures. Still, we saw the Silicon Valley Bank crisis in USA. Other banks failed. In Switzerland, your UBS failed. Okay, UBS and Credit Suisse crisis, you all know, because of, you can say the recent crisis is more about asset liability mismatch. Are you getting me, everybody? So what are the three pillars of Basel III? Yes. First is minimum capital requirement. Second is supervisory review process. Third is market discipline. Okay. So you all know that one thing that can save you is money, right? That's why we go for saving. That's why we have PPF account. That's why we have NPS account. That's why many bankers are fighting for old pension scheme. Many are happy with the new pension scheme. Okay, so people want to save for the future, whatever the crisis may be, medical accident, your children is not looking after you, but if you have money, all the problem is solved. Same is with the bank. If you have minimum capital requirement, even if there are NPAs, there are loss, there are crises, you can manage, you can float if you have minimum capital reserve with you all the time. Then the supervisory process, that's why we have boss, we have a supervisor in place. Okay, I don't always say the boss as the boss, because there is no one called boss in a banking system. When you are working in a corporate, there are mere supervisors. In a ladder, you are in a position, you are working, your boss is also working, his job is to supervise you. No one is superior, but his job is to supervise you. If all supervisors, those who supervise, should be treated as boss, then we should also respect the watchman in front of your housing colony, because his job is to supervise as well. Okay. So after independence, no one should be given extra treatment because he is your boss. He is a mere supervisor, right? Then comes the market discipline. When you have a company, you have a supervisory process, you are supervising everything, you are making profit, then you should report it diligently so that the shareholder gets benefited out of it. Because by running a bank, you are not only serving your depositors, your lenders, your borrowers, you are also serving to the general people who are holding and buying shares of your bank. Those who are buying shares of your bank could be general public with a low income. So if you show something bad, you show something or you hide something in your balance sheet, etc., that could impact their trust and their money could get eroded. That's why after the Adani fiasco, SEBI took a note, Supreme Court took a note. It is not about the Adani's money. It is all about the public who have invested in Adani, right? So these are the three pillars on which the Basel III stands. So if you have all three in place, that means we all know about the banking system. They have minimum capital requirement, they disclose it. Okay. When they hit the crisis, when there is low deposit growth, nowadays there is a deposit crunch. Still banks are surviving because they have adequate capital. The requirement of capital in India is 11.5%, but they have a lot of it, right? They have a lot of it. Many banks are having capital adequacy of 19%, 20%. Supervisory review process, there is mechanism, RBI is regulating it, there are internal audit, there are disclosures, so it's okay. And they are doing regulatory filing and share market filing. They file to BSE, NSE, whenever there are rumors, everything, they file it diligently. So as a public, we know everything. And that's why our markets are in place. These are the three pillars: minimum capital requirement, supervisory review process, market discipline. So what is capital requirement? Or we say it as a capital adequacy ratio. Capital is divided into two parts: tier 1, tier 2 capital of the bank. divided by risk weighted asset ratio. Basel is nothing but the game of tier 1, tier 2 capital by RWA. If you understand RWA, you understand the complete Basel norms. So many times we get confused about CAR versus CRAR. Both are same, but when layman say it's capital adequacy ratio, but as a banker, you must always say capital to risk weighted asset ratio. Got it? Both are same things. So capital adequacy ratio measures a bank's available capital. It is expressed as a percentage of bank's risk weighted credit exposure. Capital adequacy means a commercial bank should have sufficient capital in order to absorb any unexpected sudden losses arising out of its business. So capital adequacy is a shock absorber. It is also known as capital to risk weighted asset ratio. Okay. Like there were COVID-19. Many people lost their job during that time. So if somebody was having 1 crore of FD, would he have worried? After COVID-19, everything got normalized. He again got back his job. By that time, how he lived? He lived from his saving because he was having adequate capital, right? He was having adequate capital. So adequate capital means extra cushion, extra buffer, extra safety. That is what capital adequacy ratio is. Getting my point? So tier 1 capital also have two types. It is called tier CET, common equity tier 1, and additional tier 1 capital. Common equity tier 1 capital is a component of tier 1 capital, and it encompasses the ordinary shares and retained earnings. So how the common equity tier 1 capital is formed? And every year you are earning 100 crores, and out of 100 crores you don't spend everything, you retain some of your profits. That forms the common equity tier 1 CET1. Then additional tier 1, which that money you raise from the market through perpetual non-cumulative preferential shares, innovative perpetual debt instruments, or capital reserves representing surplus arising out of sale proceeds of your assets. So these are three ways where you raise tier 81 capital, additional tier 1 capital. If you would have known about the Yes Bank crisis, you have known about the people who invested in 81 bonds. 81 bonds means when you bank issue 81 bond, that means they need additional tier 1 capital. These are one kind of debt instrument. What is preferential shares? They are above equity shares. Equity shares are normal ordinary shares, but preferential share carries a certain percentage of dividend payout. That means if you have a preferential share, when company gets profit, a certain dividend or as a part of the profit. Okay. After I define you tier 1, tier 2 capital. Okay, tier 1 capital, both tier CET1 and 81, you now know it. Then tier 2 capital is the subordinate capital. Okay, it is secondary capital. Like what do you consider as your prime money? What do you consider as your prime income? You are getting money from your salary, and whatever you are earning, it is coming to your salary account. The money left in your savings account, maybe your CET1. Okay. Additional tier 1, the interest you are getting from your FD, etc. Right? What could be your tier 2 capital? Like you have invested in SIR, you got bonus. Like you all are bankers. For you, tier 2 is additional money. Like all of a sudden you got your 11th bipartite pay revision arrears. That was a cushion money, that was extra money. It was not on your calculation, you got it. Like each year you are getting PLI, performance linked incentive. Okay. So you get that, right? It is not sure, but all of a sudden you are getting, but it is secondary to you. It has no quality. It has no guarantee that every year you will be getting PLI, right? Apart from all your other income, PLI is additional. When you get it, you buy an iPhone, you invest in a mutual fund, you do that, right? So that is undisclosed reserves, revaluation reserves, the reserves that is not disclosed in your balance sheet, revaluation reserves at a discount of 55%. Okay, you discount, you revalue your assets, then you discount 55%. What is left is your tier 2 capital. General provisions and loss reserves, like provisioning you do for your NPA, you know that in future you may incur losses, so for that you keep additional amount, so that extra amount is also your tier 2 capital. Hybrid capital instruments like debt plus preferential share, you issue bonds, bond plus preferential shares, hybrid instruments with the characteristic of debt and debt and equity. Subordinate debt, additional loans you take, investment reserve account, okay, that all are